Hey y'all, welcome back to the Wealth Planning Podcast with Brister Law, where we focus on how to build wealth and keeping it. I'm Anthony Brister, and today's episode is for everyone who's looking at the calendar and dang, it's already the middle of March and I haven't even touched my taxes. But listen, there's still moves that you can make. In fact, I'm going to share 7 powerful deductions you can still take advantage of. And I'll tell you about clients who went from crying over a $12,000 IRS bill to actually getting a refund because of the deductions she didn't know about. So stick around to the end because I've got a bonus strategy that might give you months of breathing room to pull it all together. So let's jump in. Let me paint you a picture. You've been grinding all year, working 9 to 5, and a side hustle. You know taxes are coming up, but life happens, and then boom, it's March, and your CPA is like, you owe $15,000. You're thinking, how am I going to come up with this kind of money? The real villain here isn't just the IRS. It's your procrastination, lack of information, and sometimes even following that bad advice. But what if I told you that there are still moves left on the table, and even now, in the middle of March? Let me confess something. I've been there. Early in my career, I had a growing side hustle that turned into a nightmare tax bill because I didn't know what I could or couldn't deduct. In law school, actually, I worked as a contract paralegal, and I got hit with self-employment tax. That I didn't really know or plan for, and it sucks. I remember sitting in the kitchen, TurboTax with my laptop, felt like I'm doing everything I need to do. Why do I feel broke? And then that's when I started diving deep into the tax code, and I realized that the system is set up for those who know how to play the game. Now, I help people like you avoid that panic moment. So let me just give you the same blueprint I wish someone had given me before I had started. So first up, the number 1 deduction is retirement contributions. First deduction, retirement, and it's not too late. If you're self-employed, you can still open up and contribute to a SEP IRA or a solo 401k if you had it open last year. You can contribute to these accounts all the way up till you actually file your taxes, even if you extend it. Let me tell you about Mike, a freelancer making $120,000 a year. He thought his taxes were done. It was in the middle of April. We opened up a SEP IRA, and he was able to contribute $20,000. And guess what? We were able to shave off significant amount of taxes from his taxable income, and we saved him over $5,000 in taxes. And the best part is that money is now growing in his retirement account for his future, and it's tax deferred instead of going out and wasting it on a vehicle or something that he didn't need. Next up, this one might make people a little bit nervous, but is 100% legal if done right, and that's a home office deduction. I once worked with a client. She was a single mom with a candle making business. She had an office set up in one of her rooms, but she never claimed it as a home office. We measured the space, and it turned out to be around 12% of her house. We wrote off that 12% for her rent, utilities, internet, and it saved her over $3,000 that year. The moral of the story, don't let fear stop you from taking what's rightfully yours. And the pro tip, take a picture of your workspace as proof, and then document those expenses and keep track of it. It's simple but powerful tool. The deduction number 3, and I see this all the time, and it's because of bad books, and it's missed business expenses. Missed business expenses. Let's talk about a story. let's call this girl Rachel. She runs a side hustle in social media management. She was using her personal debit card for business expenses like Canva, Zoom, lunches, mileage. Everything was mixed together. We sat down and I had her go back through her bank statements and highlight anything remotely related to business. And in an hour, we found over $12,000 in missed deductions just for that year. And that's real money. So if you think I didn't have that many expenses, I challenge you. Pull those statements today and you'll be surprised what you missed. Next up, deduction number 4 is the HSA. So this one's really good. Let's talk the HSA. You have until April 15th to contribute for last year. This is a triple tax deduction, there's a triple tax benefit with the HSA. So when you contribute, you get a deduction, and when you spend that money on qualified medical expenses, that also comes out tax-free. And you're allowed to grow and invest that money, and as long as it stays in the HSA, that money would remain tax-deferred. So for 2024, the limits are $4,150 for single and $8,300 for families. If you have a high deductible plan, don't sleep on this. The next up, deduction number 5 is mileage and vehicles. Think about this. Every time you drove for your side hustle last year or your business, you could have been getting paid. I helped a guy who was doing a rideshare driver track his miles. He drove over 15,000 business miles at 67 cents per mile. That was $10,050 of deductions. If you miss mileage, you're missing money and leaving money on the table. And if you bought a heavy vehicle, think SUV or truck over 6,000 pounds, you might qualify for bonus depreciation and write off a chunk of that vehicle in the year you purchase it. So the 6th deduction that I want to go over is the Augusta Rule. And here's one that not a lot of people are actually using, or they've heard about it, but they're scared to do it and not really sure what to do. So you can rent your house to your business or to a stranger for up to 14 days a year and not claim that income. That income you can receive tax-free. So if you're doing this with your business gets a write-off and you get to pick up that income tax-free. So imagine $1,000 a day at 14 days, that's $14,000 in tax-free income. Think strategy sessions, team meetings, content creation days, client events, things like that. You need to actually be holding business, and then the rate needs to be reasonable. But as long as we're following those rules and paying a reasonable rate, we can deduct it and use the Augusta Rule. So the 7th deduction is charitable contributions. This is last but not least, but charitable donations. If you donated clothes, furniture, or cash, make sure that you value these properly. Make sure that you keep receipts. You can use a donation valuation tool to document everything. Even the small stuff adds up, and you deserve credit for the generosity that you are giving, right? And then lastly, the bonus play, right? And this is extending your tax return. We're in March right now. For your business owners, you've got this year until March 17th. File an extension. Don't file an inaccurate return. Extend, make a tax payment, and then figure out what we've missed. You've still got time. If it feels like it's too much right now, breathe. You can file for that extension. This will give you until September 15th for the business returns and October 15th for personal to file. But remember, you still have to pay the estimated tax payments by April 15th. But extensions give you time to do it right and save more. So there it is, 7 deductions and 1 bonus play you can still take before April 15th. And if you're thinking, Anthony, this is overwhelming. Book a one-on-one strategy call. Use the link below or go to bristertaxlaw.com. And if this has provided any value to you at all, please share this episode with a friend who needs to hear it and make sure that you subscribe. Until next time, keep building wealth and keep it.